In any case, we're joined now by Citigroup Chief U.S. Equity Strategist Tobias Levkovich. He says that equities are the most favorable asset class right now, and he is forecasting another significant rally over the next 6 to 12 months. Tobias, great to have you with us. Of course, Sheila, John here with me as well. Okay, we may see a rally by the year end, but right now there's no conviction in the markets, right?
Absolutely. I think the market's going to have trouble through the summer. I mean, typically stocks move with earnings trends, and the third quarter is your weakest earnings trends. That's why the old adage, sell in May and go away, tends to come to fruition.
Right.
Highly correlated market movements with earnings. Third quarter, you have summer vacations in the U.S. during July.
Is it just all about the summer, or is it just about the risks out there?
I think if you believed that the economy was all of a sudden going to strengthen, like last year, where you had the sequential improvement from the first quarter's weakness in earnings, then you can rally the market. In this instance, it's unlikely you're going to get that new invigorated economy in the third quarter.
Because people are just so split about it, right?
Well, you've got the issues in Europe. You've got likely some fiscal responsibility that's going to come in the U.S. as well.
Is there any one catalyst you see that could kind of take us out of these summer doldrums?
Not in the summer. I do think as we get into September, October, and we start focusing on the midterm elections and people start focusing on the fiscal issues, because that's the real issue. Everybody's very worried that the Greece phenomenon can come across the water and hurt us as well.
But then wouldn't that bode for the markets to go down by the end of the year?
No, actually, if you start getting the sense of fiscal responsibility, markets will be encouraged that we're moving in the right direction. I think investors are very, very worried about what they see is just is kind of a spending, as one client was telling me in Europe last week, a spending orgy in Washington that's got to be, addressed.
Tobias, not every stock or sector is the same story. You're going to have some earnings stories that make people get excited. There's got to be some sectors that you say are going to do better because of earnings season than others.
Well, I don't actually worry about the earnings season specifically. I don't look at the dynamic of what's the quarterly number. Obviously, you care about what the future guidance is, and I think one of the pieces of work we just put out was looking at capital spending plans of 625 plus U.S. companies, excluding financials. And what we were seeing was a real turn. 3-4 months ago, their 2010 capital spending plans were down 1%. Now they're up 5%. It's being heavily driven by autos, by industrials, by pharmaceuticals.
And is that CEO optimism, or what is that from?
Well, no, it's actually their business plans are looking at what their credit conditions or the cost of capital relative to their returns on capital. Historically, cost of capital leads investment activity by about 9 months. This signaled that we were heading into a real problem in mid-08. It's signaling a clear turn as the latter part of last year. So this is kind of the normal pattern. Yes, CEO optimism is back, but that tends to follow stock prices.
So follow stock prices.
Yes, CEOs look at their stock price, it plunges, and they start worrying, oh my God, the market knows something that I don't know, let me curtail spending. And on the other side, with the markets going up, they get more confident.
Very quickly before we go to break, stock buybacks, that's something that a lot of people have been talking about, using some of that cash?
We're seeing it certainly on our desks. We're hearing about it a lot more. This is a far better time to be doing it than 06 and 07 when companies were kind of buying at the top.